In 1988, the people running one of the most sophisticated investment funds on Earth were almost certainly the smartest people in the room. And being the smartest people in the room is exactly what nearly destroyed the global financial system. This is the story of how that's possible. The fund was called Long-Term Capital Management. It was based in Greenwich, Connecticut in the United States, a quiet town for what was about to happen inside it. It was founded in 1994 by a man named John Meriwether. Before this, Meriwether had run the bond trading division at one of Wall Street's most powerful firms, Salomon Brothers, eventually becoming the firm's vice chairman. Around him, he assembled a team that included some of the most respected minds in finance anywhere in the world. By the end of 1997, this fund had borrowed more than $125 billion from banks and securities firms, against less than $5 billion of its own money. And its outstanding contracts, its derivatives, added up to more than $1 trillion. $1 trillion. From a fund most people, even today, have never heard of. And in September of 1998, 14 of the largest banks and financial institutions in the world were called into a single room to figure out what to do about it. Not because anyone particularly liked this fund, but because if it failed in an uncontrolled way, what happened next might not have stayed contained to this one firm. And here's the boundary of what this video is actually arguing. This isn't a story about whether the people who built this fund were smart enough. They were. By any reasonable measure, they were. This is a story about what even the best model, built by the best minds, can't see coming. And by the end of this video, you'll understand exactly what that means. And why it's worth thinking about, no matter what year it is. Let's start with how this fund actually made its money, because the mechanism is the whole story. Let's start with something simple. 2 bonds, both issued by the same government, both paying the exact same interest rate, both maturing within months of each other. The only real difference between them, one was issued slightly more recently than the other. And for reasons that have nothing to do with how safe either bond actually is, investors slightly prefer the newer one. That preference shows up as a tiny gap in price, a fraction of 1%. But both bonds will pay out the exact same amount on the exact same schedule, backed by the exact same government. Which means that tiny gap is eventually almost guaranteed to close. A tiny, temporary, almost guaranteed to close difference between 2 nearly identical things. That is the entire foundation of this strategy. Now, a fraction of a percent doesn't sound like much, because on its own, it isn't. If you have $100 and you capture a fraction of a percent, you've made a few cents. So how does a few cents turn into the kind of numbers we open this video with? You don't change the size of the gap, you change the size of the bet. This is leverage, and it's a literal idea. Borrowing money so your position is bigger than your own money alone would allow. If you can borrow $24 for every $1 you actually have, a tiny gap isn't producing a few cents anymore. It's producing 25 times whatever it was before. And that is exactly how a fund with less than $5 billion of its own money ended up controlling more than $125 billion in positions, the number we opened with. By the late 1990s, according to widely cited reconstructions of the fund's trading activity, this fund had more than 60,000 individual positions like this, running at the same time across markets around the world. And here's something that might surprise you. Roughly 80% of those positions were in government bonds from the G7, the world's largest, most established economies. Not exotic, not speculative sounding. Government bonds from some of the safest governments on Earth. On paper, this was one of the most conservative-looking portfolios on Wall Street. That just happened to be conservative at a scale that had never existed before. And this exact kind of strategy, small, repeatable edges executed at massive scale through technology, is the ancestor of something I've covered in full elsewhere, the algorithmic trading that dominates markets today. But for this video, there's one thing about that strategy that matters more than anything else. For years, it worked. And if walking through how the bond market, the repo market that finances this kind of leverage, and central bank balance sheets all fit together, the parts of the financial system most people never see, is the kind of thing that's grabbing your attention right now, that's worth knowing. That's the entire foundation of a course I built called Applied Macroeconomics. One of its modules walks through the repo and interbank lending mechanics that make this kind of leverage possible in the first place. And another module covers the broader pattern this entire video turns out to be an example of, something economists call a Minsky moment, the point where stability itself quietly builds the conditions for instability. The link is in the description below. Because here's what happened in the years before 1998. This fund worked spectacularly. Trade after trade, the tiny gaps closed exactly the way the models said they would. Year after year, the returns were good enough that this fund became one of the most talked about operations on Wall Street. By the start of 1997, according to detailed academic reconstructions of this fund's books, the picture looked like this. Roughly $7.5 billion of the fund's own money, supporting total positions of around $129 billion. That's a leverage ratio of about 17 to 1. High, but not unusual for this kind of strategy, and lower than some of its competitors on Wall Street at the time. Then, late in 1997, the partners running this fund made a decision. They looked at the size of the fund, and they decided it had grown too large for the opportunities actually available in the market. So they gave money back. $2.7 billion returned to outside investors. On the surface, this looked like discipline, like a fund saying, we have more capital than we can responsibly deploy, so we're handing some back. And in a lot of ways, it was discipline. But here's the part that mattered most, and the part almost nobody outside the fund seemed to fully register at the time. When they returned that $2.7 billion, they did not reduce the size of their positions by anything close to the same amount. The balance sheet stayed roughly the same size. Only the equity underneath it got smaller. Same risk, less cushion. Their leverage ratio, that 17 to 1 we just talked about, climbed towards something closer to 25, even 28 to 1. Right around the figures we opened this video with. And here's where this gets genuinely interesting. At the exact moment this fund had more confidence than ever, it had quietly become more exposed than ever. More confidence, more exposure at the same time. And the timing could not have been worse, because 1988 was about to bring something this fund's models had never seen. Not because it was impossible, but because it simply hadn't happened in the historical data the models were built on. But before we get to what happened in 1998, there's something about the people who built these models that you need to know. Because it's the key to understanding what's coming next. Here's something about the people who built this fund that we haven't mentioned yet. Remember the team Merriweather assembled? Some of the most respected minds in finance from the start of this video? 2 of them were professors, economists. Their names were Scholes and Robert Merton. And in October of 1997, while this fund was actively running the strategy we just walked through, Scholes and Merton were jointly awarded the Nobel Prize in Economic Sciences, not for anything related to this fund directly. For a formula they developed decades earlier, a method for calculating the value of financial derivatives, alongside a third economist, Fisher Black, who had passed away before the prize was awarded. That formula is, in some form, still used across the derivatives industry to this day. It's one of the most influential pieces of mathematics in the history of modern finance. So think about what we actually have here. The two men being celebrated on a global stage for teaching the world how to put a price on risk were, at that exact moment, running a fund that was about to dramatically misprice its own. This isn't a joke at their expense. The math they developed wasn't wrong. It's still used. It still works, within the conditions it was built for. But here's the boundary we set up at the start of this video, now fully in view. Being right about the math and being right about what the math doesn't cover. Those turned out to be two completely different things. And in 1988, this fund was about to find the edge of what its mathematics could see. Let's go back to the bigger picture for a moment, because there's one more piece of context worth having before we move forward. By 1998, this fund's success had attracted enormous attention across Wall Street. Other banks, other trading desks had watched what this fund was doing and started doing versions of it themselves, which meant the tiny gaps this fund relied on were starting to get smaller and more crowded. Not because the math had changed, because everyone else had read the same math. And that's where things start to get difficult, not because of one bad trade, but because of what happens when a strategy stops being a secret. So here's what a crowded trade actually looks like, not in theory, but in a real specific example from this exact period. Early in 1998, the leadership of Citigroup, which by then owned Salomon Brothers, Merriweather's old firm, made a decision to shut down Salomon's bond arbitrage trading desk. That desk ran trades very similar to the ones we just walked through. And when a major trading desk gets shut down, its positions don't just disappear. They get sold. All at once. Which means a huge number of positions, very similar to the ones this fund was holding, suddenly hit the market, all being sold by the same seller at the same time. And when a large seller dumps a large position into a market all at once, prices move against that position, including for anyone else holding something similar, including this fund. So now, the gaps this fund's entire strategy depended on weren't just shrinking because the trade had become popular. They were actively moving in the wrong direction because someone else, for reasons that had nothing to do with this fund's own decisions, was forced to sell. This is worth sitting with for a second. Nothing about this fund's own positions had changed. Nothing about the underlying math had changed. But the price was moving against them anyway, because of someone else's forced sale. And here's the question that sits underneath everything in this video. If a model is built using years of historical price data, and that data has never included a moment where a forced, unrelated sale moves prices against you at exactly the same time other risks are also rising, can that model actually account for it? Not is the model wrong. The model isn't wrong about what it was built to measure. The honest answer is, a model can only see what's inside its data, and this specific kind of moment simply wasn't inside the data yet. By the summer of 1998, this fund's positions were already under more pressure than they'd ever experienced, and the historical data still hadn't seen anything like what was about to happen next. Because what was about to happen next didn't start on Wall Street at all. It started thousands of miles away, in Moscow, Russia. Thousands of miles from Wall Street, in Moscow, Russia, the summer of 1998 had been building towards something. For more than a year, a financial crisis that started in Asia had been spreading, moving from country to country, market to market. Russia's government had been borrowing heavily in its own currency, the ruble, issuing short-term bonds to cover its budget. And by August of 1998, that borrowing had become unsustainable. On August 17, 1998, the Russian government did two things on the same day. It devalued the ruble, and it defaulted on its own domestic ruble-denominated bonds, debt issued in its own currency to its own creditors. Now, pause here for a second. This fund, back in Greenwich, Connecticut, did not have a major direct position tied to Russia. This wasn't their trade. So why does this matter to their story at all? Because what happened next had almost nothing to do with Russia specifically, and everything to do with how every other investor on Earth reacted to it. When a government defaults on its own debt, the kind of debt that's supposed to be among the safest there is, it sends a signal. And the signal is, if this can happen here, what else might happen somewhere else that hasn't been priced in? Investors across major markets moved the same way at the same time. They sold anything that looked even slightly risky, and they bought anything that looked safe. Government bonds from the largest, most stable economies on Earth. Remember those tiny gaps? The ones between a slightly newer bond and a slightly older bond, both backed by the same safe government? Those gaps didn't shrink towards zero, the way the models expected. They went the other way. Hard. Because suddenly, everyone wanted the newest, safest, most liquid version of safety, and didn't care about the tiny difference in price anymore. Here's the boundary again, in its sharpest form. This fund's models were built on years of historical data, and in that data, these specific gaps between nearly identical safe assets had never moved this far, this fast, all at the same time, across almost every market the fund was in. Not because it was mathematically impossible, because it simply hadn't happened yet in the years the model had data for. Until that month. Let's talk about what this actually did to the fund's capital. On July 31st, 1998, using figures from the US Treasury's own analysis, this fund held about $4.1 billion in capital, already down roughly 15% from where it started the year. Then came August. In that single month, the fund lost another $1.8 billion. That brought its total loss for the year to more than 50% of its capital. Capital base, at that point, roughly $2.3 billion. And it kept falling. By September 22nd, just over a month after Russia's default, this fund's equity had fallen to around $600 million. $600 million, against more than $100 billion in positions that hadn't shrunk nearly as fast. The leverage ratio at this point wasn't 25-1 anymore. By some estimates, it was now well over 100-1. And on September 23, 1998, one day after that $600 million number, something almost happened that very few people know about. According to widely reported accounts of that day, a group that included Goldman Sachs, the insurance company AIG, and the investor Warren Buffett made an offer. Buy out the fund's partners for around $250 million. Inject roughly $4 billion of new capital. Take the entire operation over. The offer was not accepted. So that offer fell through, and the fund's equity kept sliding. Which brings us to September 23, 1998, the date this entire story is often remembered by. The Federal Reserve Bank of New York, part of the United States central banking system, had been watching the situation closely. Not because this fund was a bank, it wasn't, but because of who this fund owed money to and who was on the other side of all those derivatives contracts. Virtually every major bank and brokerage firm on Wall Street had some exposure to this fund, as a lender, as a counterparty, or both. So the president of the New York Fed brought together representatives from 14 of the largest banks and brokerage firms in the world into one room. This is the room we opened this video with. And here's the part that gets misunderstood the most about what happened in that room. The Federal Reserve did not bail this fund out with public money. Not $1 of government funds went into this fund. What actually happened was 14 private financial institutions agreed together to put up $3.6 billion of their own money. In exchange, they took control of the overwhelming majority of what remained of the fund. Why would 14 competing banks agree to cooperate like this? Here's the honest answer. It wasn't generosity. If this fund's positions had been dumped onto the market all at once in what's called a fire sale, the prices of those positions would have collapsed. And every one of those 14 institutions was holding similar positions or was owed money by this fund, or both. An uncontrolled collapse of this fund would have damaged all of them, possibly more than the cost of the rescue itself. So this wasn't 14 competitors showing mercy. It was 14 competitors recognizing that if this fund collapsed badly, the damage wouldn't stay contained to this fund alone. So instead, over the following months, this fund's positions were unwound in an orderly way, sold down gradually instead of all at once. By the end of the year 2000, the fund had been wound down entirely, and the people in that room in September 1998 went back to their normal jobs, having just managed, quietly, one of the more significant financial near misses of the late 20th century. So let's bring this all the way back together. A fund built by some of the most accomplished people in finance, including 2 Nobel Prize winners, built a strategy based on tiny, well-documented, historically reliable patterns. It used leverage to turn those tiny patterns into enormous returns. It worked for years. And then, one government default in a country this fund barely had direct exposure to triggered a reaction across global markets that the historical data had never contained. The patterns the models relied on didn't fail because they were wrong. They failed because the world did something the data said it essentially never did, all at once, everywhere, at the same time. And the 14 institutions in that room weren't there to punish anyone. They were there because letting this unwind badly would have hurt all of them too. That's the actual story. Not smart people did something dumb. Smart people did something smart and ran into the one category of risks that smart doesn't fully cover, the risk of what your data has never seen. Before we get to how this connects to wherever markets happen to be when you're watching this, one more thing. This video is not arguing that intelligence, expertise, or sophisticated models are worthless. It's arguing the opposite, actually. They're necessary. This fund's models were truly excellent, by any reasonable measure. What this video is arguing is that even the best model, built by the best minds, validated by the most prestigious recognition in the field, has a boundary. The boundary isn't a flaw in the model. The boundary is just where the model's data ends. And here's a quick note, while we're on the subject of boundaries. Everything in this video is about understanding how a financial system works, not a recommendation about what to do with your own money. If anything here made you think differently about a strategy, an institution, or even just how confident you should be in any single approach, that's the value. What you do with that is yours to work out, ideally with people who know your specific situation. Something I've written before connects directly to everything we just covered. Education on what is right, happiness, prosperity, and growth, and what is wrong, leading to ruin, is crucial. But there must be proper planning, structure, rules, individual freedom, and rights to ensure things are done the right way and kept on track. Considering confirmation bias, ignorance, lack of accountability, and many other factors, whether for a nation, the world, the universe, or oneself. And that's really the challenge this entire video leaves you with. Take whatever, right now, in whatever year you're watching this, is being described as the smart money. The fund, the strategy, the approach with the best track record. The one everyone points to and says, these are the people who actually know what they're doing. Ask the same questions this video just walked through. What's the model built on? What does its historical data actually contain? And what has it never contained? And if the thing that breaks it is something the data has simply never seen yet, would anyone even know until it happens? If you made it this far, you clearly find this kind of thing interesting, which means the videos about to show up on your screen right now are probably exactly what you're looking for next. They go even deeper into the kind of financial history and institutional mechanics we just covered. And if this video gave you a useful way of looking at risk, models, and overconfidence, hitting like and subscribing helps more people find this kind of breakdown. The ones that actually explain how these systems work, not just what happened in them. Thanks for watching.